Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Keith Lerner of Truist writing the S&P 500 bull market just marked its third anniversary and delivered the sixth strongest six-month rebound in history. As we enter the final 2 months of the year, history is on a bull's side. Keith joins us now for more. Keith, good morning.
Good morning. Great to be here.
Great to see you. What are the tailwinds that you're so confident about right now?
Well, I think the main thing up front, I think this bull market deserves the benefit of the doubt. And we have all these carousel of concerns. As one concern recedes, we have another one to talk about, which makes it interesting. But the North Star of this bull market has been simple. It's been profits in our view, and those profit trends are still moving higher. Forward 12-month estimates for the S&P are moving higher, but they're also moving higher for the average stock. They're moving higher for the small caps as well. And we also have a global bull market. It's not just the S&P. We have 90% of global markets in uptrends, and we're seeing, the EFI make a fresh 52-week high. Emerging markets make 52-week highs, and then even as we get some jitter, some kind of uncomfortable, some headlines around the tech trade, money's not leaving. It's rotating. And then lastly, this morning, look at the AAII sentiment this morning. It's up to 49% bearishness. That's the highest since May. And we're still, as we're talking this morning, the Dow's at an all-time high.
I've asked this question 50 different ways. Earnings are great. Jobs data is not. When does the jobs data start to matter to this market?
It's a good question. I mean, we all talk about, people are talking about the K-shaped economy. We talk about the two-speed economy and the two-speed stock market. So, in some point, when you think about it, profit margins can benefit from wage growth slowing, but at some point, you need that consumer spending to help the economy move forward. So I don't know the exact date, but I think that's part of the reason why you've seen more weakness in some of the consumer discretionary space, the retail space. But we also have to remember the large cap market in particular is not driven by the low-end consumer.
Well, and frankly, I mean, we've got Kevin Gordon coming on later, and I love his comment in a note where he said we're transitioning from a vibe session to a vibe-pression, and how there seems to be this increasingly negative view of the economy, but it has not translated into what people actually do. Retail therapy seems to be the solution to everything. So at what point do you just ignore this and take a look at what companies are saying, whether it's the airlines, whether it's the retailers, especially on the high end, consumers are still spending? And
that's right, and we're seeing it still even in the credit data that we follow also. So you're right. I mean, if you look at the headlines, look at consumer sentiment. We just had sentiment really just at really low levels. But when you test that out from a stock market perspective, a year later, the market tends to be up in a meaningful way. So I don't want to dismiss it because it is a two-tiered economy, two-tiered market. But big picture, if you're investing in the S&P 500, you're investing in these tech stocks. And as I mentioned, even globally, we're seeing some good activity as well. So when that turning point is, it's hard to say. But in the first quarter, we will see a little bit of a boost with some of the tax refunds. We're going to see maybe hopefully more clarity on the tariff side and maybe some more incentives on the business side. So I do think we'll see a little bit of an uptick. Maybe on the margin, people feel a little bit better.
Is it going to be inflationary? And this is really what Fed officials are grappling with. And honestly, I don't envy them, given the fact that they're grappling between potentially allowing inflation to become unmoored or causing permanent scarring to the labor market. How much can they really cut if you do get that boost to consumption in the early part of next year?
Yeah, it's a good question. It's a tricky situation for them. There's a lot of these different cross currents, but I will say there are maybe a little bit of an uptick because of the AI spending, because of the tariffs. But on the other side, we do have wages cooling somewhat. We have oil prices in the 60s, and what we led the program with was housing. Housing prices are softening as well. So that doesn't seem to me like a runaway inflation environment as a whole. And I'd also say, we still think the Fed ultimately moves towards 3% on the Fed funds by the end of next year. Whether they do it in December or January, I think people kind of over-fixate on that. We also have to remember that, on the way up, the economy was somewhat less interest rate sensitive, and it may be a little bit less interest rate sensitive as they cut. So I don't think that's the most important thing by far for the markets.
Do tax rebates change your outlook? $2,000 checks?
I think what it does on the margin is it lifts up maybe a slight uptick on GDP. Is it a game changer? No, but I mean, that's one of our main theses as we move into next year is getting a little bit more clarity and having a slight uptick in the overall economy. And, those tax stimulus checks do help out on the margin.
It's the focus of the White House. You can feel the shift.
Yeah.
It's all about affordability right now. The president said it almost directly yesterday, following the reopening of the government shutdown. So when you look out to 2026 and you've got a very narrow, concentrated equity market and a consumer that's been struggling and a president determined to do something about it going into the midterms next year, is that going to be the trade for next year?
Well, a lot of the question right now is, do we move out of tech? And we're still sticking with tech. I'm waiting for confirmation on some of the things we look at, relative price trends, relative earning trends, to go into this broadening trade. We have to remember, we came into this year, and what was the big theme? It was the broadening theme. It hasn't worked out. In fact, part of even the movement over the last couple of days, the rotation back there, is because they've underperformed so much. So the rubber band got stretched too much. So I think there's a case to be made for the broadening story again next year because of the uptick, because of the Fed still cutting rates, and we've had such outperformance by tech. But I also look back at different cycles. I look back at the 90s, and I look back on the 2000s, and the leaders of bull markets tend to lead to the end. Doesn't mean there's not some intermittent mean reversion periods, but tech was the leader until March of 2000, and emerging markets were the leader into 2007. So I expect, even though there's these worries and these concerns, I think tech will ultimately still lead. If you believe you're in a bull market, I think ultimately tech has to participate and likely lead, even if there's some bouts of underperformance.
How much is this for tech? Heads I win, tails you lose, in the sense that either they do really well and they continue to boom, and the Fed's cutting rates because the rest of the world's not doing so well, and so then they continue to boom even more because there's more cash looking to go to work, or the whole world gets better and adapts to some sort of AI paradigm, and they also benefit. So how much is that the reason why it's sort of, in some ways, the riskier free bet for a lot of people in their portfolios?
Well, I think what happens with all these macro cross currents, the news headlines from day to day, you see these kind of short-term rotations into other areas, and then when people feel uncomfortable, where they go right back to tech. So, but you raise a good point too. One of the main questions I'm getting today is, are we in a tech bubble? And the other thing to keep in mind, going back with the Fed, is the Fed was raising rates in the late 90s, 2000. We're not doing that. We're still on a trajectory of actually moving lower. So I think I'd like to see a broadening. I'd like to see not a two-speed economy. I think most of us would like to see that as well. But I think you're right. I think if things slow down, money moves back to tech. And if the Fed cuts rates, people still stick with tech because of the financing side and the secular growth.
If the Fed is cutting in the face of inflation that has remained above the 2% target for more than 5 years, does that mean you should invest in the rest of the world and not necessarily the U.S.?
We're still Team USA. We've been Team USA for a long time. I think, we did last fall, we increased our exposure to EM, we increased our exposure to international developed. And I think a lot of times people just think about, hey, it has to be either or. And I say there's both with a bias. And our bias is still with the US. We still think that's the innovation. And what we also look at is, when we look at over the last decade of international underperformance, you can overlay that with earning trends. And the earnings momentum for the US has been stronger that whole time. So what we're looking for to really say it's time to go even heavier into the international markets is to see those earning trends move up. We have seen better price action. Valuations are cheap. Sentiment has been negative coming into this year. But we still haven't seen the earnings. Now, EM, emerging markets, is more of a tech play relative to, say, the EFI, which is more of the kind of cyclical financials, industrials, and things of that nature.
Keith, can we just go through the data? What were you expecting to see, and how quickly were you expecting to see it?
I don't know that I had expectations when it was going to come through. It's a cloudy period. Our head of economics, I feel bad for him every day, even though he had a little bit of a vacation. And for me, and for what we do, I just go back to profits. I'm focused on what the companies are saying, which tends to be more forward-looking anyway. So, and we also have to remember, I'd rather have data, but we also had jobs numbers early this year that were revised down by 900,000. So we all want the data. It's still the gold standard. It makes it cloudy, but I think we still have enough information from these private sources, along with what companies are telling us today, to say that the economy is still kind of muddling along. And then we also know some of the factors that we talked about next year, why there should be potentially a little bit of an uptick in our view. And then, we've talked a lot about the Fed. Maybe this clouds their decision as well. I don't think the Fed is the most important thing for this bull market to continue. I think it's probably more important for the rotation trade that the Fed continues to cut rates and we move towards that 3%. On the tech side, it's not the main driver. So, all in all, we'll get through this, and 3 or 4 months we'll be talking about something else. Maybe we'll be talking about the midterm elections by then, which will be coming as the main headline in 2026.
Well, midterm elections are going to be determined by the economy, and the economy has seemed increasingly divorced from corporate earnings, which you've talked about. At what point is that unsustainable?
Yeah, it's going back to what we talked about earlier. I think something else we have to think about too is we focus a lot about job growth, but we still have almost somewhere around 160 million people working. So I think what's also important, not just the monthly jobs number, is wage growth staying above inflation, and right now it is. So as long as we can continue that happening, and we have those folks, that 160 million people working, the consumer can still move forward, maybe not at the pace, but we still have this kind of, it's if you don't have a job, it's difficult. Some of the college kids we're seeing not getting a job, it's difficult. So that I think that divergence is likely to persist, especially as you throw on AI on top of that.
Just real quick here, going forward, what's more important to hedge against, inflation or a slowdown?
I think a slowdown. I know our base case is for those reasons that we see a little bit of an uptick, but the labor market has been somewhat soft. And I mentioned already, we are seeing some of those other factors like housing, oil prices are somewhat down. And even though wage growth is above inflation, wage growth is slowing. So, and that can change quickly. So I would say that the hedge against would be the slower economy. And that's why maybe also, you've seen a little bit of rotation, maybe it's more specific, but some healthcare. What I'd be looking for too to say that the market's actually concerned about a slowdown would be things like consumer staples starting to do better. We're not seeing that as of yet, but that's what we'll be watching early into the new year.
Stay with us. More Bloomberg surveillance coming up after this. Stock rally on pause following the end of the longest government shutdown in history. Kevin Gordon of Schwab, likely saying this, likely we'll have to wait until the beginning of 26 to get a clear read on the health of the labour market, raising the risk of a shock to markets, especially if the delayed jobs report are released all at once. Kevin Gordon joins us now for more. Kevin, good to see you.
Hello, John Farrow.
I'll get that right. Thanks for catching up with us. Let's talk about this market and the prospect of $2,000 checks. Does that change the outlook for you, this shift towards affordability?
Well, I think the prospect of the checks, we'll see what how that actually nets out. If we learned anything from the past 5 years of issuing out checks to Americans and directly giving them money in several rounds, yes, you could argue it contributes to an inflation problem, but it also doesn't solve anything on the sentiment or the confidence front. As you pointed out earlier in the show, alluding to this vibration that we've started to think about, sentiment has only continued to get worse as inflation has remained sticky and above the Fed's target, and price levels have been, still so egregiously above where they were pre-pandemic. So I'm not so sure that it's necessarily going to be an elixir for what ails a lot of the economy from a sentiment standpoint. And then I think from an inflation standpoint, more importantly, I certainly don't think it'll do anything to help bring, inflation a little bit lower, because even if you take out what was a really strong disinflationary force in the September CPI, which was shelter. I know there's a lot of controversy around excluding certain components, but the core parts of inflation are still relatively sticky. If you do core services, ex-housing, and CPI, you're still running above 3% on a year-over-year basis. That hasn't really budged. You look at a chart of just general year-over-year change in CPI, that's hovering closer to 3% on average, not 2%. So there is a little bit of a difference in the inflation backdrop post-pandemic, and we're sort of living in and experiencing it real time.
Every day that passes, this becomes a dated conversation because we don't have updated data.
Yeah.
And might not get another CPI report for quite a while. What's been the biggest problem for you, the absence of data or the data we have seen?
I think it's been the absence, and I think it will be the absence for a while. As you alluded to in the quote, I'm getting sort of more convinced that it's going to take until probably the end of January, maybe well into the end of the first quarter of 26 until we get a clear read, at least on something like the labor market, because we're looking at this data hole in October, HOLE, not WHOLE, where you're likely going to miss, even if you get some reports like the non-farm payrolls report, it's probably not going to be clean. Retroactively, you have to ask businesses businesses, for the establishment survey, what the employment situation was like. I think the likelihood you get the household survey is pretty low, which that's not going to mean that the payroll number is meaningless, but I think it will take down a lot of the sort of, the scale of it, or at least the importance of it, because if you have the payroll number but you don't have the unemployment rate, we don't really understand what the supply situation is looking like. So because of that, and because you're going to then be missing revisions, and you're also past the reference period now for November, I mean, there's a whole list and I could go on, but I think all of that adding up gets you to a point where into the first quarter of 26 you probably have maybe a little bit of a cleaner read on labor. Plus you get the benchmark revisions towards the beginning of next year. So that's going to also be a pretty key driver.
So let's talk about the vibe session turning into a vibe-pression, the idea of how much you have seen sentiment data fall off a cliff. It has recently been gut-checked by the hard data coming from the government that actually things are okay. And you're seeing that gut check, if there is one, right now coming from the earnings. Is this something that's sustainable, the sort of breakdown between the vibes and how people feel and what actually is going on in economic activity?
Well, it's sustainable in the sense, and I'll give a hat tip for Vibe Session coined by my pal Kyla Scanlon. So we're sort of building on the framework that she established. But, I think that it's sustainable in the sense that it's become the norm, whether you like it or not. I mean, just look at the math, look at the data post-pandemic. In the past 5 years, you've only continued to see sentiment get worse. I know UMich gets a ton of flack because of maybe a little bit of a political bias and how much is driven by that. But the current conditions component of the UMich Sentiment Index is at an all-time low, meaning you have a base of consumers saying the current environment is worse than the financial crisis, it's worse than the 1980s, it's worse than the late 1970s. So I think it's sustainable in the sense that sentiment in this cycle, and I think for at least the near to medium term, is not going to be an indicator and a forward-looking indicator for the trajectory of the economy. And I think that's somewhat consistent with how the base of growth has been shaped this year, where it's become narrower, it's become increasingly driven by business investment. Clearly, as we've all talked about every single day, the AI CapEx portion of that on the tech and the software side, the hardware and the software side. So I think it is consistent with what has happened in the economy and how things have developed. But I just don't think it's going to be that traditional leading indicator for the economy, because it hasn't been. It's
a leading indicator, though, for politics. And
yes.
There is a feeling right now that is going to come with some proposals. And you were talking earlier about the $2,000 checks that could come out. And I just wonder whether the bond market is starting to price in, or when it will start to price in, a series of potential proposals that John's been outlining could potentially be quite stimulative.
Yeah, well, I think from the bond market's perspective, when we came, I sort of rewind back to a year ago when we were all putting our outlooks together for 2025, and collectively we were assessing, what is the policy risk, both from Washington but also on the monetary policy side. And you do have almost an equal set of headwinds and tailwinds for the equity market, but also the bond market. You think about things that are more growth negative, like tariffs. I mean, we do have elevated tariffs. We're probably going to be living in a high tariff world for the foreseeable future. But you also have some form of fiscal stimulus coming from the big beautiful bill, but also potentially coming from additional measures, whether it is checks. So in that sense, and I think you pointing out the sort of the little move down that we've seen in the 10-year over the past year. But if you zoom out over the past several years, it's kind of been stuck in this range, and that makes a lot of sense to us because of these competing forces that you have. So I don't see a whole lot of that changing, especially because the business investment environment is still so fertile and it's so strong right now. And you're expected to get a little bit of a bounce back in consumption with, when we get third quarter GDP. Of course, fourth quarter and then into first quarter of 26 is going to be distorted by the shutdown. But there's still no indication, because of the stock of the labor is still so high right now, there's still no indication that you're seeing this massive drawdown in spending. And we've had some alternative data that have underpinned that and emphasized that have shown that, retail sales haven't fallen off a cliff. The weekly economic index from the Dallas Fed is still pretty stable. So we've been able to see that the consumer is still broadly resilient.
Can we just finish on the setup for 26 in markets? So 12 months ago, a lot of people bulled up on Buy America. When we went to Davos, Switzerland last year, it was ridiculous how long everyone was, one theme, and that was the United States. What happened? An out of consensus rally in Europe. Lasted for the first half of the year at least, but it was massive. How do you think we're set up with that in mind for 26?
I think that, to the extent you get a little bit of a reversal in some of the forces, like the falling dollar in the first half of this year, that was almost to the date a one half 2025 story. The dollar is stabilized and it's actually actually, last I checked, I think the best performing out of the G10 so far in the second half of the year. So even if that stays relatively stable, or you get a bit of a pickup because you have rate cuts that are priced out from the market in terms of the Fed, I think that could maybe work against some of the ex-US trade, particularly in Europe. But the setup for the US, what I think has become really important to watch, and this is sort of manifested over the past couple of weeks, and importantly this week so far, where the breadth picture under the surface for the S&P 500 has actually started to improve. So there's been a little bit of closing of the gap between the equal weighted index and then the cap weighted index, where even though you're seeing some digestion over the past couple of weeks, there has been a little bit of a catch up from the average stock, which is really important because by the end of October, you're at 26% of members in the index that were outperforming the index on a rolling 3-month basis. That's incredibly low relative to history. So anytime you go through that sort of washout down the cap spectrum and outside of the top 10, you really need to see that gap close in favor of the average stock, the so-called average stock. And so far, that's happening. So I think it's a relatively healthy sign. But what needs to happen, I think, in the next 4 to 5 weeks is a pickup in what I think of as sort of the holy grail metric for breadth, which is the share of companies that are above their 200-day moving average. That's come back up to 60%. So I think if you continue to see that climb as the index health improves, then I think that has gives you a relatively solid setup for 26.
Stay with us. More Bloomberg surveillance coming up after this. Bond yields inching higher this morning as traders look ahead to the central bank's December meeting. Lisa Hornby of Schroders writing, "We continue to believe that persistent labour market softness and mounting pressure on lower income households will keep the FOMC on track for a December rate cut." Lisa joins us now for more. Lisa, good morning.
Hi, how are you?
Is that becoming a closer call?
It is, and I actually think the Fed is doing a pretty good job of keeping that optionality, right? Powell came back out kind of after the press conference saying it's not a done deal. Don't think it is. But at the end of the day, our view is that the data we have seen, particularly some of the layoff data, has deteriorated. And so they probably will prioritize, at least for this meeting, the labor market over the inflation side of the equation.
Are we taking this meeting by meeting, just 25 at a time and work out where we land?
I think we are, and I think we should be. That's fair, right? The economy it's not bad. I mean, growth-wise, I actually think next year is going to be a kind of a weird year where growth can actually be okay, but the labor market probably continues to soften a little bit. Possibly because of the reasons that growth is okay, the AI spend, some of these numbers that are coming out, CapEx, it's possibly in contrast to the labor market. But the Fed is going to have to figure out what things do they prioritize in this. And, December, I think they probably lean towards the labor market. Next year becomes a little bit more of a question.
Let's say the Fed does cut an additional 25 basis points next month, and let's say they signal they are open to doing more next year. What are your clients going to do with some of their money market funds? Is that enough to kind of push them out into, say, longer duration or even into 50-year alphabet bonds?
Well, let's hold on the alphabet question for a second. But I think that's the right call, right? There's been a tremendous amount of money parked in money market. This has been a great call. I think some of that is going to find its way into longer duration as we continue to see yields fall. We have seen it, and I think we're already starting to see some of that money shift. I think there's probably more to come. I mean, unfortunately, generally retail tends to be a little bit late to that, so that we may get the money in as we're reaching the bottom of the Fed cutting cycle, but I do think that probably will be happening.
So let's talk about the 50-year alphabet debt, not necessarily whether or not you bought it or anything like that, but I am curious how much you are seeing fund managers pushed into greater risk in a way. They're looking for the same kind of income. They're looking for outperformance. AI is the hot trade. Yep. How much do people almost feel forced to absorb this incredible glut of debt issuance?
So there's a lot of questions in that question. I think one of them is the market is shifting quite dramatically in terms of tech and what that means to the bond markets, right? Some of these issuers are forecasted to become the largest issuers in the corporate index in the next few years, kind of surpassing, potentially surpassing some of the Verizons and the AT&Ts, the larger non-bank issuers. And so that's a really structural and fundamental shift that I think investors need to get their heads around. What does it mean? Meta's issued massive amounts of debt just in the last 6 weeks. Their balance sheet and the structure of the company in terms of how they fund is changing dramatically. So I think there's a big question as to what does tech look like in the corporate index in a year's time versus what it was maybe 6 months ago. I think investors are looking at that, but there are other opportunities out there that I wouldn't say aren't as crazy risky. Look at tax-exempt municipal bonds. I think maybe last time I was on the show, we might have talked about them. They underperformed treasuries at one point this year, 6.5 percentage points. This is not a crazy risk trade.
Are you saying that the other is crazy risky?
I'm saying that you can buy local government debt at pretty reasonable yields compared to treasuries and actually have some alpha generation potential there because they have underperformed this year. Google didn't exist 50 years ago, so I'm just putting that out there. I'm not saying it's not going to exist in 50 years' time, but there are questions about that and their funding mechanism.
You keep alluding to it slowly, and we'll keep coming back to it. Are you worried about corporate credit?
Look, spreads are tight. I think that there is probably a repricing that's going on in the tech sector, and I think those curves need to steepen. There are some interesting issuers that are coming today, possibly today, actually.
Yeah.
But I don't think we can paint them all with the same broad brush.
As they issue more, does it make it a higher quality index or a lower quality index?
So we were just doing some work on this yesterday, and I'll credit Morgan Stanley. They are the ones who came up with the stat. They said they think that the big four hyperscalers can probably issue $700 billion without impacting their ratings. So, I don't have better insight than them. These guys have been looking at this very closely.
Over what period?
I don't know if that was a year or a couple of years.
$700 billion without
They don't think that's what
rating.
the issuance will be. They're just saying that's what they think they
But ultimately, that's a green light for them to issue, to borrow.
And by the way, the cost of equity versus cost of debt, they might as well be funding in the debt markets. So I think there's a lot of issuance to come. There's a lot of data centers to be built, guys.
Stay with us. More Bloomberg surveillance coming up after this.
Bloomberg Economics estimating the shutdown will subtract 1.3 percentage points from fourth quarter GDP. The Federal Reserve now hoping to shake off the data fog ahead of their December meeting. Kristina Campmany of Invesco writing, we expect clarity on the calendar for US data flow within the few days coming out of a shutdown, but expect data to be noisy at best, with the potential for market bias to discount data extremes. Kristina joins us now for more. Kristina, good morning.
Good morning. Thanks so much for having me in.
Some doubt about payrolls being released now,
Yeah.
and not just CPI. What's your base case?
Look, I don't know if we get the data or not, but I think either way, we know that the data is going to be really noisy. So we finally will start getting data flow, but I think we have more murky water coming probably into year end. And there's a lot of questions of, do you get both payroll reports on the same day? And I think the extremes, exactly like we said, are going to be discounted. And I think we have to go back to what the story's been all year, that you've had really weak sentiment data that kept getting re-anchored by decent or hard tier 1 data. And then the breakdown came in the summer when you got the revisions to the labor market data and weakness. And now we've had no real data, so it's just been this very weak sentiment data. So where do we go from here? Do we have the hard data re-anchor? And I think that's like a really important path forward. And I think you look at the consumer too, even though sentiment data has been so weak, the consumer spending numbers and the credit card data numbers have still been robust. So you still have this bifurcation of like, well, which is it? You don't feel good, but you're still spending.
You're right to point it out in the summer. The start of August, that July jobs report changed the conversation. Coming out of the summer, we caught up with you, and consensus started to develop into the idea that the Federal Reserve was going to start an easing cycle. They went 25. They went 25. Is that now developing into a prolonged pause at the Federal Reserve?
So Powell clearly came back and pushed back aggressively on the market's pricing at the October press conference. And I appreciate wanting to have some kind of flexibility and not be priced over 100% for December. Like, that's reasonable from the Fed. For me, what I have a harder time with is even the pushbacks at the October meeting, and you've started to hear more noise and grumbling around the Fed. And I think probably a noisier Fed is here to stay, and you're going to hear like a wider range of voices. But for me, it's hard to say you supported one ease in September and you're going to dissent in October. We're talking about monetary policy that has long lags and is a blunt instrument. So easing 25, being okay with 25 but not 50 feels like a challenging one for me. So we've always kind of been in the camp of you deliver 75 to 100, similar to last year, and then you can sit on your hands and say, let's see how this actually feeds through the economy. So our base case is still that they can go in December.
Did you write a letter to the Kansas City Fed?
We did not. But there's so many moving parts. And I think the reality is they'll probably still be flying blind data-wise. And when you're flying blind, I don't think that means Powell talked about putting on the brakes or pausing. I don't think that means you like avert course and change the direction.
I think a lot of people agree with you. I mean, right now the pricing in Fed funds futures is more than 50% for that December rate cut. I just wonder why we're not seeing any kind of steepening in the yield curve, given the fact that probably early next year we are going to get some stimulus checks. We probably are going to get some fiscal efforts coming from Washington.
Yeah. So look, I think we've been in the camp to have a steeper yield curve for much of the year. And I think the frustrating part, we've like gone in bits and bouts of like we've steepened, we've flattened it back, has been the long end for us. And you think about all of the fiscal dynamics in the U.S. and obviously the U.S. is the U.S. so it has that benefit in markets, and it is the most robust, deepest market, so it has that benefit. But we're at the low end of yields in 10s and bonds, and I don't know that we're discounting or like fairly pricing in the tax policy risk. You're going to have stimulus next year. So do we need to, like, even if the Fed eases, do long end rates need to be lower? I don't think so because of where we are. Are we pricing in inflation risk? Inflation's kind of been sticky.
There's one argument that if you have the Fed that's cutting rates, people who've gotten accustomed to getting income on their cash are going to look for other places to get their income. And they're not necessarily going to go straight into equities. They're going to go into duration. Mm-hmm. And so they're going to lock in those yields, which will keep a lid on how high yields can go, regardless of the backdrop of the deficit and inflation and all of these other concerns. What's your take on that argument?
I think the argument about all-in yields, certainly for credit and front-end high-quality paper, like I think that's a real argument. And it exists out there, even though as a rates person, it's a frustrating argument because you say, like, why not barbell and be in the front end in the U.S. in treasuries or in rate product and then out the curve? But I think that it's a different dynamic for 30 years. And I think that 30-year point globally, that steepening and all of the pressures there is a global phenomenon. Like, look at what's going on in 30-year JGBs and under the new government. This kind of combination of reflationary policy and a much weaker yen and it's like you're pushing on all of the limits and something's going to break. And I think we've learned this year that all of these markets are interconnected and what goes with one will affect others. So
10-year bond yield's been a bit of a pain trade this year. Trades this morning at 4.09%, ended last year, last trading day of the year, 4.57. Yeah. That bond yield's lower, not higher on the year so far.
You know what we haven't mentioned yet today? $25 billion of 30-year notes coming out at 1 p.m. An auction today of 30-year notes. 6 months ago, that would have been exciting. Right now, people are like, there's plenty of demand coming in. Are you
suggesting it's not exciting anymore?
I think it's still exciting, but I think that other people are less excited about it, so I'm not going to beat the drum as much because, I don't feel like getting hate mail this early.
If you care, we should care.
Okay, well, I think people should care because ultimately this is a testament to how much people are actually looking at the global dynamic as well as the sort of potential buyers versus the inflation picture, which could potentially surprise the upside.
A lot of supply coming into credit as well at the same time.
At the corporate supply, and a lot of it has been all of this AI-related, very long-dated issuance, which has been absorbed with ease. And like we talk about the credit market, I mean, credit spreads are very tight. So you have to sit there and say, like, what are the risks out there?
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.